Welcome back. You're watching Ian King Live. Standard Life and Aberdeen Asset Management have given more details of their planned £11 billion merger. The two fund managers confirmed they'd agreed a preliminary deal on Saturday after the news was broken by Sky News' Mark Kleinman. And both sets of investors welcomed the news today, with Standard Life shares rising by more than 5.5%, while Aberdeen shares climbed by more than 4%. Under the terms of the deal, the two current chief executives will become co-chief executive, while Standard Life's chairman, Sir Gerry Grimstone, will be chairman of the combined company. And he's with me now. So you're casting this very much as an expansive merger, a big aggressive move. A lot of people would say it's quite defensive given the client outflows that you've both experienced lately.
I don't see it that way. We're creating a new global champion. We're creating the UK's largest active fund manager, the second largest in Europe, 19th largest in the world. It's not often in the UK nowadays you get a chance in financial services, to do things like that. We've been thinking about this for a long period of time. It's been something that's been in the making for a long time. In these people businesses, you can only do these deals if the people want to do it. So a very important ingredient was bringing the two CEOs into alignment and looking at their respective personalities and seeing this would be a great combination as joint CEOs.
But isn't it defensive, though, because in the fund management world, funds are now moving rapidly away from active fund management of the type that you do towards passive fund management, cheap index trackers?
But in a way, and you could say in business, everything is defensive. You're always trying to defend your position and move forward. Standard Life has an incredibly powerful business. Whenever I go out and about in the UK, I'm always amazed by the number of people I bump into who we help with their pensions and savings. So our inflows have been very robust over the last year. But it's always been part of our strategy. Our journey is to turn the company upside down. When I started at Standard Life back in 2003, we were Europe's largest mutual life assurance company. Do you remember the demutualisation, all the adventures of that? Well, we got through that. And then we said what we had to do was to make this a global investment company. So increasingly, investments have been the top, and the insurance has been the distribution arm for the investment company. But we still have 1.25 million shareholders. The number's hardly gone down at all in the last 10 years. And that says something about the quality of the company.
Bit of loyalty. So the customers are quite a lot. I mean, indeed, Standard Life is a much bigger business than Aberdeen, and yet you're casting this as a merger. I mean, some would say this is really a backdoor takeover of Aberdeen, but without you having to pay a premium for a takeover.
Well, look, these are people businesses, and you have to respect each other. There's fine people in Aberdeen. I'm very pleased there's going to be some fine members of the Aberdeen board joining the Standard Life board. But I think you have to be grown up. If you want to make these combinations, you can't let ego. Sometimes with chief executives or with boards, there's so much ego around, you don't do what's best for shareholders or for governance. I think in this case, we've reached a solution, which, as you've seen from the share prices today, is really good for both sets of shareholders.
But can having a co-chief executives really work? I mean, having two chief executives has been a recipe for disaster everywhere else it's been tried.
I think it's a disaster unless you think it through very carefully. Keith and Martin have known each other for many years. I've known both of them for many years. I don't want to psychoanalyse them on the programme, but actually they are different individuals, different strengths, different qualities. So I'm really hopeful it'll work well, the two of them working together.
Well, the city scuttlebutt has it that in a year or so's time you'll take over the chairmanship of Barclays, and Martin Gilbert, the current Aberdeen CEO, could then replace you as chairman. Is that likely to happen?
Well, who knows what's going to happen, but I've given my word to both my present board and my new board that I will see through this integration, and I will see through. I'm not the kind of person who likes to leave a job half finished, as you know, Ian.
Indeed, but I mean, if Martin Gilbert were to become chairman at some future event, I mean, the corporate governance people at Standard Life would have a fit if that happened in any other company, wouldn't they?
Well, we are very strong in corporate governance, which is why I don't think anybody should count their chickens on this. We are a very strong corporate governance, and so is Aberdeen. But one of the strengths of our firm is we behave properly. It's amazing how a simple thing like behaving properly takes you a long way in financial services.
Brief word on job cuts. A lot of them coming down the line.
There'll be some. There's 200 million of efficiencies, but a lot of that comes from things like overlapping overseas sales offices. computer platforms, etc., etc. The headquarters of this company will be in Scotland. The other great news for this in terms of Scotland, this will be a powerful global business headquartered in Scotland.